Warren Buffett. When you think about investment success, that's the name that comes to mind, right? But how did he actually do it? Well, today we're unlocking his playbook. We're going to distill decades of his wisdom into a clear, actionable guide you can really get your head around in just the next few minutes. Let's dive in. Buffett has this amazing way of using simple, powerful metaphors. And this one? It's one of his absolute best. It perfectly frames his entire philosophy. See, investing isn't about those quick wins. It's about planting seeds that are going to grow into something huge over a very, very long time. This one idea is the bedrock for everything else we're about to talk about. And that leads us right into his first big principle. You have to play the long game. In a world that's obsessed with meme stocks and overnight riches, Buffett's approach is, well, it's radically patient. He sees investing as a marathon that lasts for decades, not some 100-meter dash. Okay, so you've probably heard his two most famous rules before, right? But their simplicity is kind of deceptive. The focus isn't really on making these spectacular, flashy gains. It's all about the relentless, boring preservation of your capital. Why? Because if you lose a huge chunk of your money, the climb back is just so much harder. Protecting your downside, that's everything. And this quote just nails that mindset perfectly. When Buffett buys a stock, he's not just renting it, hoping for a quick price bump. No, he's buying a piece of a business, and he intends to hold it forever, like he's buying the entire corner store down the street. It completely shifts your perspective from short-term gambling to long-term ownership. And hey, if you need some cold, hard proof of why this long-term view is just so incredibly powerful, look no further than this number right here. In the 20th century, a century that had the Great Depression, 2 world wars, and countless recessions, the market still delivered this staggering return. The magic of compounding, it only works if you give it time. So, the big takeaway from this first principle is that trying to time the market, jumping in and out based on scary headlines, it's just a fool's errand. The real risk isn't the temporary downturns. It's missing out on the steady, long-term, upward climb of great businesses. Okay. So playing the long game is great, but it's totally pointless if you're holding a bunch of junk, right? And that brings us to the second principle. If you're going to own something forever, you better know exactly what it is you own. This is all about the power of knowledge and staying firmly inside your intellectual comfort zone. I mean, it really doesn't get any more straightforward than that, does it? Buffett famously stayed away from things he just didn't get, like a lot of the complex tech companies in their early days, because he couldn't confidently predict where they'd be in 10 or 20 years. And that leads to one of his most important concepts: the circle of competence. Now, this isn't about being an expert in everything. It's actually about being brutally honest with yourself about what you do know, and maybe more importantly, what you don't know. The key isn't how big your circle is, but knowing exactly where the edges are. Operating inside that circle is how you give yourself an edge and seriously reduce your risk. So, once you're inside that circle, what are you hunting for? You're looking for businesses with a moat. This is Buffett's iconic metaphor for a durable competitive advantage, something that protects the business, which is the castle, from all the invaders trying to take its profits. So what does a moat actually look like in the real world? Well, it could be the unstoppable brand power of a Coca-Cola, or the low-cost dominance of a company like Costco, or maybe the network effects of an American Express. It's the special something that allows a company to fend off competitors and keep earning high profits year after year. His mentor, Ben Graham, was famous for buying what he called cigar butt companies, basically fair businesses at wonderfully cheap prices. But Buffett evolved. He learned that it's actually much, much better to pay a reasonable price for an exceptional business that's going to compound its value for decades. Quality always comes first. All right, you've committed to the long game. You know how to spot a great business with a moat. You're all set, right? Well, not so fast. According to Buffett, the biggest challenge is still ahead. Principle 3 is all about mastering the one person who can completely derail your entire strategy: yourself. So, let me ask you, what do you think it is? Is it a sky-high IQ, a fancy finance degree from some top school, the ability to build these ridiculously complex spreadsheets? What do you think? The answer is none of the above. Buffett is convinced the key is temperament. It's not about being smarter than everyone else in the room. It's about being more disciplined. It's about having the ability to control the emotional urges that get so many other people into deep, deep trouble.
And when you get right down to it, those destructive urges really boil down to these two incredibly powerful emotions. Fear, it's what drives you to panic and sell at the absolute bottom of a crash, locking in your losses. And greed, that modern-day FOMO, causes you to pile into a hot stock at the very peak of a bubble, right before it bursts. Mastering your mind means mastering your fear and your greed.
And this is where his classic baseball analogy comes in, and it's just brilliant. In investing, you can stand at the plate and watch hundreds of pitches go by, overvalued companies, industries you don't understand, the latest market fads, and there are no called strikes. It doesn't count against you. You can just wait and wait and wait for that one perfect pitch, that great company at a sensible price. And then you swing for the fences. And that brings us to our final principle, the one that really ties everything else together. This is the crucial distinction that separates a real investor from a speculator, understanding the massive difference between price and value. Now, this is a lesson straight from Buffett's mentor, Benjamin Graham. Price is simply what you pay. It's the number you see flickering on the screen every second. It's emotional. It's driven by the market's mood, by fear and greed. But value is what you get. It's the real, intrinsic worth of the business. And the whole game is to buy when the price is way below the value. And leave it to Buffett to make this idea just so intuitive and simple. We all get the thrill of finding a great deal on a high-quality product, right? He's just applying that exact same shopping mindset to the stock market. He's a bargain hunter, but for excellent businesses. This means a true value investor starts to see a market crash not as some terrifying disaster, but as a sale, a big one. When everyone else is panicking and selling everything, the market is offering you the chance to buy those wonderful companies at a wonderful price. You get to profit from the market's foolishness instead of getting swept up in it. So let's recap the playbook really quick. First, play the long game. Think in decades, not days. Second, know what you own, stick to your circle of confidence, and look for those moats. Third, master your mind. Keep fear and greed in check. And fourth, remember that price is what you pay, but value is what you get. Look, if you only remember one single thing from all of this, please make it this. This quote is the ultimate distillation of Buffett's entire philosophy. It's about having the emotional discipline and the courage to act as a contrarian, to buy when there's blood in the streets, and to be cautious when everyone else is popping champagne. So we'll leave you with this one final thought. So much of Buffett's success has been built on long periods of doing absolutely nothing, just patiently waiting for the right opportunity. In our hyperactive world that rewards constant action, maybe the greatest skill of all isn't knowing when to act, but having the discipline to just sit still.